Welcome back to Academic Market Insights. Today's video is so important. We're going to be looking at option market making. And this is really comes from a couple conversations from our really dedicated subscribers who are curious, what do market makers do? And this is something that's near and dear to both of our hearts because it seems like market makers get a really bad rep, and we're here to say, no, that's not true, that they're really doing good for the overall economy. And
They
with
absolutely,
that, take it away, Dr. Rowe.
yeah, they absolutely are. They're the last bastion of providing liquidity when we're in a pretty volatile market within the options space. But they're the ones that are there every day, buying options and selling options and posting markets and creating the liquidity that is the listed option market in the U.S. Now, a market maker, there are, I believe, 18 option exchanges right now, and I think by the end of this year, there'll be 20. The way that you act as a member, a market maker, a permit holder, these things vary from the terminology varies from exchange to exchange. You may pay a monthly fee. I don't think any of the exchanges sell seats anymore, but you have special rights with respect to trading on the option exchange, which allows you to basically post and cancel orders continuously without being charged for overly canceling orders, et cetera. If public customers try to do the same thing, they actually would start to incur some fees. Their broker wouldn't be very happy with them as well. Their goal is they want to buy an option just a little bit below the fair value and sell them a little bit above the fair value. So if you see a bid of, let's say, $1 and you see an offer price of $2, pretty good chance the fair value for that option is $1.50. And while they're trying to do this, they want to be what we refer to as delta neutral, or have as little exposure to the underlying price movements as possible. And that's really where the skill comes from with respect to being an option market maker. Yes, good first question.
So, what I'm hearing on top of providing liquidity is if the market maker is buying at one and selling at two, and the fair value being at 150, it sounds like they're doing price discovery.
They are doing price discovery, and they are basing. And what I did here is I pulled up a couple of pictures of the S&P 500 index option pit just to show some market makers in action. Basically, anybody that is in there and not on a phone, like you can see this gentleman on the front right on the phone, he's actually with XFA and he's a broker. He would call orders out to the crowd. You can see on the picture on the left, there's actually somebody yelling at something out right now. But the majority of the people in here are trading in the manner that I'm going to explain shortly. But that's the old CBOE S&P 500 pit, and then they moved across the street shortly after COVID, and that's the new option pit that you see on TV periodically. Now, again, they're supposed to minimize their exposure to the underlying. If I tell students, if you get a job in that pit right there, you're that guy, and you decide that the S&P 500, it's first thing in the morning, and you decide the S&P 500 is going to go up that day. Well, if you loaded up on a bunch of calls in the morning and you were dead on and you made a ton of money for your market making firm, you would get fired. That is not what you're supposed to be doing. You're supposed to be trying to, again, sell above, sell above a fair value, buy below a fair value, determine what fair value is by analyzing the order flow that is coming in. So the market makers, as I've mentioned, are going to be neutral in the factor, the option pricing factor that gives us an idea as to how much an option should change in value based on a change in the underlying market is delta. And you'll hear delta used a lot. I think you almost know that you're talking to a trader from Chicago if they use the term delta in one way or another. They use it as odds. They use it as being, I'm long delta, I'm short delta with respect to their attitude toward a market. But if they're doing their job right, they are going to be delta neutral. Well, what were you doing that?
That's zero.
Oh, zero. Okay.
You should be squeezing it down, right?
Squeezing it down as much. And I say, you know, as close to, and I keep using these hedge words, and that's because it's really impossible to be perfectly delta hedged
Right.
with respect to an option maker, market maker on a stock. They probably are trying to stay within 1 or 200 shares of long or short. That right, with a big book that wouldn't have a big impact upon them, but they're doing their very best not to have exposure to the underlying market. And the delta gives us an idea as to what they should do after they take the other side of a public customer order with respect to maintaining that neutrality. And that's what we're going to go through in the next exercise.
Ooh.
So we got a stock trading at 40. We've got the XYZ, and XYZ is now really a stock. I've got to come up with another ticker. So the XYZ 40 call, we're not worrying about expiration or anything else. We're just taking a look at the price here. It's $1.50 by $1.60.
Okay.
And the delta for this call, and I'm really making the math super easy. The delta for this call is 0.5. So every $1 change in the underlying stock, we would expect this option to go up or down by 50 cents. Yes.
For the number one fan, what does it mean to be 150 by 160?
The market is willing to pay $1.50 for these options, and they're willing to sell them at $1.60.
Okay.
In dollar terms, that's $150 by $160. Each option represents 100 shares of the underlying. So we take those prices and we multiply them by $100 and then tag on some commissions as well to get the absolute price.
So we're then estimating that the price would be 155.
Exactly. The fair value on these options would probably be would be about 155. You can be very certain that the bid and the offer prices are being put up by liquidity providers. I saw a breakdown of option volume in 2025 recently that Henry over at CBOE did at their risk management conference. And believe it or not, there are three types of traders that they can keep up with: public customer traders, firms that kind of trade for themselves, and market makers. And typically you would expect a market maker to be on the other side of a firm order or a customer order.
Sure.
Believe it or not, every once in a while, the market makers are now trading amongst themselves sometimes to bring their delta down. So market makers are, if you really kind of broke it down, market makers are involved in over 100% of trades.
Wow.
Yeah, they're because they do end up trading with
Great.
themselves when markets are moving very quickly sometimes. And that's a new one in the last couple of years. I think there's some short dated option factors that come into play there. All right, with our market makers, so we got somebody that likes XYZ, and this is the public customer. They come in and they want to buy 10 of the XYZ 40 calls, and they're going to pay $1.60 for those. And 10 of those calls represents 1,000 shares. That's going to come into play in just a minute. Now, the market maker, the customer bought those contracts. In delta terms, that's the same as being long 500 shares. 10 contracts represents 1,000 shares. We multiply that by the delta of 0.5. So the customer, they're bullish. They're fine with being long 500 shares. The market maker has sold 10 of these calls. Their risk when they sold these calls is that the stock goes up. And their risk is the equivalent of being short 500 shares because we're delta short 500 shares. Now, the market maker is supposed to be neutral. So the easiest way for the market maker to be neutral is to buy 500 shares at 40. So, and when they do that, the market maker is now what we refer to as delta neutral, and they're doing their job. This is what they're supposed to do. Now, so all of a sudden, so our trader, go ahead.
So going back to the last example, this is something I've been curious because I personally have never been a market maker.
Mm-hmm.
Do market makers actually buy the shares of stock, or do they hedge with a call option?
They would buy the shares of stock unless they could use a call option below the fair value.
Got it.
So a really good market maker, and yeah, that's an excellent question. I had a former intern at the Options Institute who went through the Group One training program, and on the first day they do a bunch of these, and they say, okay, you took that. What are you doing? They say buy shares. They say, and then they say, okay, this order came in, and there might be other things that they can do in the option market that's better than just buying the shares.
Sure.
The easiest example is buying the shares, but if somebody's coming in, if you got 3 or 4 option orders coming in at the same time, you're going to net the delta out of that and then maybe do something with the shares to stay delta neutral.
Okay.
So you can buy a call option, but if you buy a call option and you pay above the fair value,
Yeah.
you're not going to make your profit.
Yeah, you're not actually
You're going to give it
taking
up.
that little, yeah.
Yeah. So all right, they did good. Stock went up. I included the delta here. It's not going to come into play again, but as the stock price goes up, the delta of the options change. Sometimes the market makers need to buy a few shares or sell a few shares. Each of them kind of has their own way of doing that. I know someone who said they would do it on the open every day. Somebody would do it on the close every day. Somebody did it at lunch every day. Some people that switched it around, they said it never really made that much of a difference as long as you maintained a delta that was relatively close to zero relative to your market.
And
So, yep,
and real quick, and for those of you who are more interested in Delta, we do have a video on Delta.
we do. Yeah, we got that because Delta is by far the most important option gradient. So our public customers happy. They decide, let's just assume it's the same person. They send an order to the market. They're like, hey, I made 40 cents real quick off of my 40 strike calls. So the new order that comes into the market maker, the public customer is going to sell 10 of the XYZ 40 calls for $2. And the public customer outcome here, they bought 100 of those, 10 of those contracts. They sold 10 of those contracts, and they made a
Woohoo!
profit of $400. Yay! So the market maker, and notice I put option in brackets there to kind of give a hint as to what's going to happen here. They sold the 40 calls for $1.60 and they bought the 40 calls for $2. They lost 40 cents times $100 times 10. They had a $400 loss. However, they owned 500 shares. And some people have probably already done in their head the quick math where they bought 500 shares at 40, sold them at 41, and they made a $500 gain off of buying the shares. So their net is $100.
Woohoo!
And this is where it gets really fun. What is the bid-ask spread right here?
150 by 160, so 10 cents.
What's 10 cents times 100?
$10.
What's $10 times, that's $10 contract. What's $10 times 10?
$100.
They basically made the bid-ask spread.
Woohoo!
So they made that $100 is actually equivalent to the bid-ask spread in both instances. Now, of course, I made this very easy because we're trying to demonstrate what market makers are doing. And the biggest point behind this is they ain't trading against you. Their job is to post prices where they're willing to buy and sell options based on the type of flow that they're seeing. Their goal is to attract both buying and selling throughout the trading day and try to stay delta neutral as possible. If the market opens up and all they're seeing is buying of options, they'll take their implied volatility input up a bit, and then that might attract selling of options. And note that I didn't say, they're seeing a lot of call buying. Let's try to get people to come in and buy puts instead, et cetera. They're more, they really want to balance the buying and selling. They're not as hung up on whether the buying and selling is coming on the put side of the equation or the call side,
Right.
because they tend to move the implied volatility up and down for all of those options. The main point here is they aren't trading against the public. They're trying to facilitate orders from the public. They're directionally agnostic if they're doing their job correctly. And in reality, if you think about it, they want you to make money, because if you make money trading, They make money, some money trading. You make some money trading. You'll come back and do another trade, and you'll come back and do another trade, and they'll be able to maybe convert that to another arbitrage profit. So
Absolutely. So it sounds like that market makers are actually really good guys.
they're the good guys. You really want to
They
take
are
up
the
for them
good
here. They're
guys.
good guys. They've always been nice whenever I've had to go down on the floor and do things. So I'm extremely supportive of what they do. I'm probably their very first defenders. If anybody, says that they're out there doing nefarious things with their ability to be a market maker, they're not. They're just trying to buy. They're just trying to scalp out a living at what they're doing, just like we are at the things that we do for a living as well.
Well, and they're providing a service to the overall economy. They're
Oh
providing
yeah,
liquidity, they're providing price discovery, and they're really preventing the markets from not, to some extent, to even slow down a bit when
oh yeah,
prices move very fast.
absolutely. So all right, with that, you get to take us home. Whoop.
So, thank you everybody for watching our video. Thank you, Dr. Rowe, for explaining the unsung heroes of the option market. And we thank everybody for watching. If you like this video, please hit like. And if you haven't already, please subscribe. And if you have constructive feedback, we are very open. With that, thank you so much.